Hey guys, I'm the Newb investor. Today we'll be screening Nvidia, through my three metrics to see whether the stock is trading at overvalued, fair, or discounted prices. Except, we all know Nvidia is trading at overvalued prices. Nvidia is trading at a premium, so I guess what we're looking for here is the best entry prices for Nvidia. I am very bullish on Nvidia, but I didn't want to FOMO and buy just at whatever prices. So for Nvidia, I'd pay a premium. But at what prices? There are buyers from 330s who might be feeling a little shaken by the sell-off. I don't think you should sell, but with the current market situations, I think we won't see those highs, at least in the first to second quarter, as revenues would slightly be affected by the whole Russia-Ukraine war. This isn't really a time to buy expensive stocks, but to accumulate value stocks. Nvidia is currently trading at $237.14 with high price of $346.47. That's 31.56% of the highs. Current market cap of $592.85 billion and a very high PE of 61.64. EPS trailing 12 months of 3.85. It gives out a cute annual dividend of 16 cents per share, a 0.067% yield of the current price. Dividend is safe, comprising of only 4% of their earnings. First metric, we want an EPS lower than 3. It's 16.01. It is expensive. We get this multiple by dividing the PE by the EPS. EPS multiple of 3 is my threshold usually when I'm buying stocks because I don't want to overpay for overvalued stocks. But 16.01, is it worth buying? Let's look at my second metric. Second metric, we want to pay $1 or less for 1% of the money they're making. What you see here is the breakdown of revenues. Cost of revenues or COGS, operating expenses, net income, free cash flow. I've included this so we have an idea how much these companies spend to continue their operations and how much of their revenues they keep to themselves to further the company by acquiring other companies, to afford dividends, and to buy back shares, which would ultimately bring the stock price higher. In 5-year average, they spend about less than 70% in costs and expenses when you add COGS and OE, and they keep around 30% of their revenues to themselves. What we'll do here is to take the current year's yields and the averages of 5 and 10 years of data. The more data the better, guys, but in this video, we'll only be using 5 years of data just to show you our process. Of the 4 highlighted values, we want to take a lowest value so we can make a baseline of our assumption. In this case, it's the current year's free cash flow yield of 30.21, which then we'll use to divide our current PE to determine our discount. It is 2.04. It means we're paying at a premium of 2.04 times their cash flow yield. Basically, it's saying we're paying $2 for $1. It is expensive, but I will give you the multiples I use when I'm buying stocks like this. Third metric, we want to know our discount compared to when the markets have valued the stock before. I have here 2 historical PEs data, one from Guru Focus, which is readily available, and one from Macro Trends, where I manually pick the PEs, each rated from the range of consolidation. You'd see here the highs and the lows of PEs, the number of quarters and years I took the PE from. But what we want to use here is the lowest average PE of the two. For the same reason, we want to start our assumptions at the lowest PE. In this case, it's 31.54. We'd use that to divide our current PE to get our discount of 1.95, meaning we're buying the stock now at high PE compared before. In conclusion, the stock is overvalued in all my metrics, but it is a growing company and the fundamentals hasn't matched their financials yet. The stock is overvalued as it trades at 16 times earnings, 2 times their free cash flow yield, and 1.95 times their historical PE. I don't own the stock, not yet. I am screening this stock with my humble and honest opinion. Should you pay premium for the stock? Absolutely. You should buy at a premium, but at what multiple? Is it 2.04 times? I don't know. It's a personal preference, actually. But I'd give you my multiples. If you think at some point in time, they can increase their revenues by 10%, use a multiple of 1.25. For 20% growth, 1.5, 175.30%, and so on. Here are my entry PEs for the stock, 24, 26, 28. Very little safety margins from their yield. I think the fair value of the stock is around 115. This is when you multiply the EPS of 3.85 by the second metric, lowest yield of 30.21. My entry price would be $160, with current EPS of 3.85 and high PE entry of 28, and a multiple of 1.5 times growth, because I think Nvidia can grow 20% of their revenues some point in time in the future. Again, guys, I don't advise and I don't promote using these multiples. I'll be waiting at the sidelines for this stock as it's still too expensive for me. This three metric I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price we pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.